let's get started. Today is Thursday, the 28th of November. Only 2 days. Yeah, maybe 2 days, because I don't think we go into 31st yet. So only 2 days to finish the month of November, and we start December, and then the year is over. It has been a very quick year, right? But we've come an end nicely. So hopefully you guys could have very good year. So make sure to take some time with your family on Christmas, as well as on New Year's Eve, and whatever other celebration you may do. So happy Thanksgiving to everyone. That's correct, Matthias. Hopefully everyone can have a good one this year with after some good trading. All right. So what are we going to be looking today? Well, I've separated, some topics here. Hopefully we can get through all of those topics and still have a look at some trades, but I'm not promising anything, but I don't think we're going to be able to look at some trade ideas. Most likely we will be able to go through all those topics. So the first topic is the US dollar and the trade implications. Okay. There are some uncertainties and with the new administration of Trump. Just put this here. Perfect. There are some administrations, so we're going to take some uncertainties. So we're going to be looking at the DXY, the dollar index. Moving on, we're going to be talking about the New Zealand dollar outlook after, we had on Wednesday, yesterday, we had the 50 base points cut. Even with a cut, the market reacted really bullish. So what's going on with the market? All right. That's the one point I want to touch base. Third point is Australia's inflation landscape. We have Australia inflation coming back nicely, but still very sticky. How this can impact the Australian dollar. Let's have a look on that as well. And the last point is the bigger picture, the global market dynamics and what's going on around the globe, and how should we, go to the end of this year with the right foot. All right. Before we go any further, I just want to put the risk disclaimer up. I will give a minute to everyone, and then I will mute myself, go through everything here, and then we should start after that. Okay, so let's get started. 1 minute has passed. Hopefully you guys could read the risk disclaimer. Let's move on. So let me just take this off. Let's get the first topic on. The first topic is the US dollar and the trade implications. Now, on last Tuesday, I've talked about the US dollar being very correlated with the euro dollar, of course, right? We have euro as the base, US dollar as the quote. Therefore, the DXY basket, it's pretty much 40 or 50% euro, right? If you search it up on Google, DXY basket, you can see that the United States dollar index, DXY measures performance of the dollar against a basket of other currencies, including the euro, JPY, pound, CAD, CHF, and the SEK. So what is the percentage? It doesn't. I think I've had. Won't be able to find it now, and it's not the topic. But anyways, so basically, we've the US dollar continues to serve as I like to call a barometer for the global economic sentiment. All right, it's not only the US dollar; it's actually a thermometer for how hot or how cold the global economy is actually going. So last Tuesday, I've talked about the US dollar coming back to the 106 level. That is this level right here, 106. Perfect. That is this level right here. And it actually just touched on that and now is going up since then. I also mentioned the US dollar been on a very tight range of this consolidation between 106 to 107, right? And that's exactly what is happening. If we go to FinLogix, okay, just type finlogics.com on Google. I'm going to send I've just sent on the chat the link, and then click on chart. I'm just going to open the euro dollar. I've mentioned about euro dollar coming back to the level of 106 as well, okay? And that is right here. Let me just put this 106, done. So we didn't quite get there yet, all right? But most likely what it will happen is they will come back to this area and then reverse to the 106 level. Okay, so that's what I've told, that's what I've mentioned on Tuesday, and that's exactly what happened. All right. Some recent developments have added a more layers of complexity to the US dollar. And in one hand, the Federal Reserve less dovish instance is suggesting to us that a prolonged period of tightening financial conditions will be maintained. And of course, this reflects, a very cautious approach to balance the inflation. With trying to at the same time sustain the economic momentum, because what do they want to do is they have the Dual Mandate Act, right? So it's basically lowering the inflation while maintaining the economy growing. So that's pretty hard, because when you try to lower inflation, what are you trying to do is stop spending, stop consumption from the population. For the economy to grow, what the population has to do is they have to spend into the economy, as well as the government have to be selling products out to other countries. So that's pretty much how you grow an economy and how you control the inflation, right? But that's very hard, because with you stop trying to make the population spend, you're raising the rates, or are you hiking rates? So higher rates means harder to get loans from the bank. It's expensive to get loans from the bank. It's not harder, but it's going to be expensive for you to get a loan from the bank. You're going to be paying, let's say, 6% a year, 7% a year. It just depends on how risk your bank assess your loan. And you're going to be most likely spending that on real estate, because real estate is an asset, and et cetera, right? So, and this government that is really, really trying to, maintain it's very, very stable. Okay. Let me just, okay. So, however, some trade uncertainties under the new administration are introducing a unpredictable variable. Okay, as I was thinking yesterday, and this shift in the trade policy, it shifts the trade policy priority of the Fed, right? What is towards the protectionism or the new alliances? It could have significant implications for the dollar flows, right? When I mean flows, is people from big investors trying to buy or trying to sell, making flows to the actual sorry guys, everything outside that gets control from the US dollar. So the upcoming month and rebalancing is really, really crucial for it's a really crucial factor, right? So portfolio managers, they in big hedge funds and super funds, they will be positioning assets which may lead to temporary volatility spikes, and especially in a holiday shortened trading week, as we're approaching Thanksgiving, as Matthias just said, happy Thanksgiving to everyone. So most likely on the first and second week of November, in December, right here. Right here. So from the first week until the 15th, we may have some volatility to the upside on the US dollar. Okay. That's what I'm expecting. Okay. So, so basically, just looking at what Aditya says, yesterday's data confirms ALL3 inflation metrics are back on the rise for the first time since February 22. Core CPI, PC, PPI are now raising same. Did the Fed spark a new wave of inflation? Where did you get that from? It's a good question, actually. Did you made yourself, or you get that from? That's pretty good. We'll answer that in a second. Let me just finish about the US dollar. So looking at the US dollar index, I do believe that on the first 2 weeks of the December month, most likely we will have some up move. Maybe not breaking through this 108, all right? Maybe just actually being a bit like wider range like this one, but continue to trade higher. I don't think we may have a US dollar down for the end of the year. Okay, that's my opinion. So if we take a look at the technical point of the US dollar index, we can see that it broke the top here, and then it came back to a pullback, and now continue to trade higher, and then continue to trade higher, and then it broke the bottom. Okay, but that's the 1 hour. So would you actually count these? That's the tricky point. I want to see what you guys think. Would you count this technical as, yes, definitely broke. Now it probably will come back to 50% or 60%, and now continue to go lower to levels like here to next year. Would you take this in consideration? Well, I wouldn't, okay, because I wouldn't count as the 1 hour. I would go for the 4 hour. When we're talking a longer term, I'm talking about most likely what we could see is this being the pullback. Okay, that looks much more likely a pullback to continue to go higher. So if we actually, let me just delete all of that. If we count this part here as the end of this pullback, and now we're going to go up, we can do a Fibonacci extension, and then we come from the 1, 2, 3, and our target would be somewhere around 109,786, and then even then 112. Okay, now it comes. Will US dollar actually hit 112 by the end of this year? Look, I don't believe on that, but everything can possibly happen on the market. All right. Now, what I want to show this is something really, really interesting that it has been tricking me, to be honest. Since October, we've had this massive rally up on the US dollar, but we had it showing to me on the commitments of trader. Okay, let me bring the commitments of trader up here. Let me just bring prime market terminal to this now. Just a second. Right there. Okay, so the first tab here on the top, you can see the US dollar and its leverage funds. Okay, so since the 8th of October, all right, so since 8th of October, let me just do a mark here. 8 right here. Just a second. Oh, I actually can do better. I can use this one here. 8. So since this level, we had negative positions, all right, negative net percentage. So that means that the percentage of short positions were higher than the net. But then I look at the long and short positions. The long positions were always higher than the short positions. Okay, so from here 1990, and then 1820, 28 19, 22 21, 17 18, 30.21, 31.21. So I'm just eagerly expecting the next release to see if this continue to be a trend. If they change these to a bigger short here to a smaller long positions, then yes, we will most likely see a pullback on the US dollar. But for now, I'm not expecting that. Okay, so that's the US dollar for me today. Now I'm going to answer a detailed question. A detailed question said, yesterday data confirms AL3 inflation metrics are back on the rise for the first time since February 2022. Core CPI, PCE, and PPI inflation are now rising at the same time. Did the Fed spark a new wave of inflation? And then it says, it's just my analysis. I was studying the history pattern yesterday. Okay. All right. First of all, this is a very fascinating topic, to be honest, and it's it's a good development and raises the important questions about the Fed role into shaping the current inflationary trend. All right, so let's have a very quick look here. I don't want to spend too much time on that, but before we actually go to the Fed's role, I just want to recap the three inflation metrics. So the core CPI, so the core consumer price index, the core PCE, so the core personal consumption expenditure, and the PPIs, that's the producer price index. All right. So did the Fed actually spark this wave? Well, first one, we have lagging effects on the monetary policy. So the Federal Reserve's interest rate hikes have historically taken time to work through the economy. And while the aggressive tightening cycle initially appeared to slow the inflation, as we can see right now, the lagging effects might be showing a less desired consequence. So basically, a reappearance of the inflation as the supply chain recovers and the demand stabilize, right? The second point is the loose financial conditions. So basically, despite the high interest rates the Fed is holding, financial conditions, including the credit availability, the equity market resilience, all of these have remained relatively accommodative. So the consumers' spending has held up better than what was expected by the Fed. The labor market remains very robust, as we can see. We only had one release that was, very, very bad. But these factors could, reignite the price pressures, and especially if the business pass on higher costs to consumers, they can't take the inflation. So because if they pass the higher price to consumer end, basically what they're doing is they charging double down inflation on the consumer, and that's really not nice. The third point is the energy prices and the global factors. So basically, the energy price fluctuations have been massively big at this period, as well as the renewed global supply chain construction maybe also playing a role on that. Okay, so the raising prices on energy costs can actually filter into the PPI and the CPI, and that can create a feedback loop, right? So basically, it's like I just say about the consumer getting charged at double down inflation. So why the Fed doesn't control global commodity prices, that's why they count the core CPI as the best and not only the CPI. It's a lack of additional tightening, and it might not even be sufficient to offset these external pressures. And now the big question, a policy overcorrection. Are we talking about an overcorrection here on the policy? Well, that's another possibility, that the Fed early pivot to signal a pause, or slowly cut the rates, was interpreted as a dovish stance by markets, and reigniting the inflation expectations about the market and about the actual consumers. So if we look to the financial market, the financial market is pricing more rate cuts for 2025, and it may also contribute to consumers and business optimism and fueling more demand to this year ends. All right. Aditya say, don't you think Fed was wrong to cut 50 base points? No, I don't think Fed was wrong. I mean, they're an independent party on the financial landscape, and they do what they think is the best to do. If they think it's the best to do 50, I mean, I don't have 1% of intelligence that those guys have. So if they think that is actually worth to do a 50 base points, I do believe it is. We've seen inflation coming down. Yes, it may be fake, but we have to work with the numbers we have. We can't be predicting what we think it's going to happen or something like that, right? So, yeah, if they done right, I agree. If they done wrong, I don't think so. I don't think so. I think what they did was on the right moment. They've held the rates for longer than what was weighted. So yeah, I believe so. Yeah, I believe it was right. Okay, so moving topics now. So New Zealand dollar, right? So the New Zealand dollar, what I want to bring here is this. And I want to send this link to everyone. Sorry, Aditya, I hope I answer your question. Yes. So what I've just sent to everyone on the chat is the RBNZ, so the Reserve Bank of New Zealand website. And what I want to talk about this is, okay, thanks, Alicia. Yes, amazing. I like the answer. Thank you. So what I want to talk now about the RBNZ, right? So we saw yesterday, the New Zealand dollar, the Kiwi dollar being focused following the Reserve Bank of New Zealand recent monetary policy decision of cutting 50 basis points. Early yesterday, I think it was 12 p.m. on Wednesday, we had the RBNZ implementing a 50 basis points cut. While this was widely anticipated, what caught the market off guard was the actual central bank less dovish tone in the forward guidance. Okay, the forward guidance pretty much means that the monetary policy statement. Okay, so the statement is what they released to us to see, and that's what is caught the market sort of off guard. So the RBNZ emphasized that while the economic growth has slowed, they have some key indicators such as the inflation. They are sort of stabilizing near the target range, and the optimism contributed to the New Zealand dollar to rally very, very strong yesterday, as the markets was interpreting the forward guidance, the central bank forward guidance tone as a signal of measured but deliberated sort of policy adjustments moving forward. Okay, so what I want to share with everyone is on the RBNZ website, you can click on the link I've sent, and you can come to read the announcement here. And we won't spend much time here because that's quite a big and extensive words. But basically, what I've just told everyone is what is being talked on the whole thing here. Okay, so it was published yesterday, and they say here that annual consumer price inflation has declined and is now close to the midpoint of the Monetary Policy Committee's 1 to 3% target band. Inflation expectations are also close to target, and core inflation is converging to the midpoint. If economic conditions continue to evolve as projected, the committee expects to be able to lower the OCR further early next year. Wow. RBNZ did a cut before the RBA. That's insane. Anyway, economic activity in New Zealand remains subdued and output continues to be below its potential. With excess productive capacity in the economy, inflation pressures have eased. Domestic price and wage setting behaviors are becoming consistent, with inflation remaining near the target midpoint. The price of imports has fallen, also contributing to a lower headline inflation. Economic growth is expected to recover with 2025 as lower interest rates encourages investments and other spending. Let me just drink some water, guys, because my throat is going crazy. All right, perfect. So employment growth is expected to remain weak until mid of 2025. And for some financial stress, will take time to ease. Global economic growth is expected to remain subdued near term. Geopolitical conditions and policy uncertainties could contribute to increase economic and inflation volatility over the medium term. The Monetary Policy Committee agreed that having consumers' price inflation close to the middle of its target band puts it in the best position to respond to any shocks to inflation. Aditya says, RBA and Silk also say that we expect to cut rates further in early 2025. Yes, that's correct here. So the committee expects to be able to lower the OCR further early next year, right? As I say, the Reserve Bank of New Zealand pretty much emphasizes that while the economic growth has slowed, there are some key indicators such as the inflation, they are stabilizing near the target range, okay? And it's very optimistic coming from them because this will contribute to lower the costs for the population to leave. And of course, contributes as well to the rally on the New Zealand dollar. Markets interpreted the central bank tone as a more deliberated policy adjustment moving forward. However, what I like to say is that this recovery doesn't come without challenges, all right? Inflation volatility will continue to persist, and the external risks, including the commodity price fluctuations and the trade uncertainties, remain on the radar. So one of the most important topics I would say is the agricultural sector that is a bright spot, right? Supported by very strong payouts and favorable conditions. Now, let's have a look at some factors that was actually influencing the medium-term outlook for the New Zealand dollar. Now, if we have a look at this this image here, let me see if I can bring that to you. Perfect. Let me see if I can zoom that. All right, perfect. This was what I've had before the actual rate cut. All right. So the MNZ had two options, right? To cut interest rates by 50 basis points or 75 basis points. So there was two strengthening scenario and the weakening scenario. So the strengthening scenario was the RBNZ announces 50 basis points rate cut, or ideally a 25 basis points cut, accompanied by a hawkish forward guidance. Comments indicated a series of 50 basis points rate cut may not be necessary, with 25 basis points cut likely moving forward. In this scenario, NZD, New Zealand dollar would strengthen, and the market reduced their expectations for a rate cut. So think of this way, right? So the market was extremely aggressive pricing cuts, with 75 basis points cut considered to the worst case scenario, having more likely 40% chance of occurring, okay? So since that worst case scenario didn't play out, the market is now reassessing its dovish pricing. So as the IBNZ cuts the OCR by 50 basis points to 4.25% as expected, while it say that the OCR was lowered further as inflation returns to the target and expects to lower to the OCR further early next year, there are some points that continue to make the New Zealand dollar strong on the medium to long term. Medium, I would say 2-3 months, and long term, I would say 6 months is stronger. Okay, I would say most likely medium term. Okay, most likely medium term. I think it would be the most important thing. Now, what is the reaction? Okay, so if we go to FinLogic's New Zealand dollar USD, So as we can see right here on this area, here, so the New Zealand dollar immediately moved higher by around 20 pips from 0.5830 right here. Just put it. Right there. Okay. So from the beginning of this big candle here. Sorry guys, just a second. Right there, much better like this. To all the way to 58.50. Okay, from the top here, 58.50 around here, and then after that it continued. So 20 pips right there. All right. So that's 200 points, 20 pips right there. So if you were using one lot, you would be making $200. If you were using two lots, you would be making $400. But as well, keep in mind, if you're short, you would be losing $200 or you would be losing $400. Okay. So basically my analysis for the RBNZ is that the RBNZ was, we'll deliver it on a consecutive 50 base points rate cut, and was widely expected, although there were some outside chance bets on a greater 75 base points. But the central bank note that the OCR was lowered further as the inflation returns to target, and it's expected to continue actually reducing the OCR early next year. While of course I also need to noted that the global economic growth is to remain subdued in the near term, as well as the economic activity subdued. Although economic growth is expected to recover in 2025. In addition as well, the central bank lowered its OCR forecast across the projection horizon, with the March 2025 view at 4.07%. Previously, it was 4.62%. December 2025 view is now at 3.55%. Before it was 3.85%. And then March 2026 now at 3.43%. And then previously it was 3.62%. Okay. So I know I'm spending a lot of time on New Zealand, on RBNZ. It's already 20 minutes I'm talking about that, but it's definitely worth to be talking. Okay. Do you guys have any questions about it? Okay. Tell me, Sweets, what's your question? How can I help you? Stop loss. There's a couple of ways of stop loss. Yeah. My personal favorite. All right. The question is to be bullish on New Zealand dollar. Okay. That's a good question. So I took a trade on Euro New Zealand. Okay. I took a trade short. Let me go for 50 minutes. The trade was from, I think it was like here down to here. Okay. So that was the trade I've took. But I'm not bullish on New Zealand US dollar. Okay. Yes, I'm bullish on New Zealand dollar, but not on New Zealand US dollar. Okay. The reason is US dollar is very strong. I would be bearish on Euro New Zealand dollar. If you want to trade New Zealand dollar bullish, you can trade Euro New Zealand dollar short, as well as you can trade GBP and New Zealand dollar short. And you can trade Australian dollar, New Zealand dollar short as well. That's going to be my my best pick for the for trading, the New Zealand dollar bullish. So I've sent on the chat what I think it's best to worth. All right. Euro the first, second AUD, and third GBP. All right. So Euro is very weak. Second is Australian dollar, and then third is pound. Okay. That's what I think. Okay. Now, let's turn to Australia and the inflation story. What's going on here? So basically, I forgot to show. I had separate here, but very quick. I just want to come to here. That's the inflation. That's more to Aditya because Aditya was talking about if the Fed has done right or wrong. Have a look at this, Aditya. I sent the link. Everyone can access, of course, but this is the link I used to actually see the inflation from USA. It's from the USA Bureau of Labor Statistics. Have a look at here. It breaks down all the items, food sector, energy sector, all items less food and energy, and services less energy and services. Okay. It's pretty good. You can read it through. It's really, really in depth. All right. Very professional. Not a problem. Okay, so let's move on to Australian dollar. Okay. USD. All right, perfect. Let's go for the 4 hours. Okay, so the headline inflation rate on Australian moderated to 2.1% year on year. I've done a blog on that today that you guys can definitely have a look. I will send the link, but it's on acwhite.com and then come to learn and then market analysis. And then you guys can just wait to load. And then it's right, this $1 data and decision key insights from November market trends. And then you can have a look on that. Right, basically here, right there, we can see that the inflation came down to 2.1% in October, primarily due to declines in energy related costs, such as the fuel and the electricity. For those who live here in Australia know that the fuel have been coming down. I don't know outside of Sydney, but I'm in Sydney. I think Stuart is in Sydney as well. We do had a cheaper price on oil the last couple months, I would say. But however, what actually imports is the core inflation, and the core inflation remains very sticky. Okay, particularly in the service sector and the non-tradable goods. So one of the most concerns, one of the most high concerns I would say that the RBA has is the persistently high cost of housing and rentals. We have like one bedroom here for $600, $700 a week. We're talking that a week. That's a lot of money, okay, for one bedroom. And this is like an inflationary pressure that is challenging the central bank to adopt a dovish stance. And there will, many of other problems, but that's the one of the biggest problems, the house cost, the shelter cost, okay? The RBA is definitely navigating a complex ocean, I would say, okay? And they have to be very cautious about providing some support to the Australian dollar because if, the Australian dollar most likely will be on a sharp decline in face of all of these monetary policy. Now, if we take a look at the CPI breakdown, just imagine that. It's very important to understand that the biggest market in Australia is actually the real estate market. A normal person get paid here in Australia is somewhere around 70,000 per year. Okay, so let's just do a quick maths. Before tax, right? $70,000 before tax. $18,000 is not taxable. Yep. Okay. And then after that, there's $52,000. 25% is taxable. All right. minus 52K. Plus 18. Divided by 12. That's how much you get usually pay if you are on a $70,000 yearly salary. Okay, that stands for weekly $1,187. Now, if you're living alone with a 1-bedroom, you will be paying around 500, 600, 650 if you want to live close to the city. Okay, so basically, your rent is somewhere around 50% of, sorry, $1,180 is around 50% of your budgeting. The rest 50%, you have to spend probably 15 to 20% in food, and then transport if you don't have a loan on a car, and then your money is gone. All right. So it's really hard. It's really hard if we try to understand the CPI, how the CPI is actually affecting it. It's very complicated. Okay. And it's just getting worse and worse and worse. So it's really tricky. Matthias say, I like the about the outer. I like the about the outer about you on the blog. Oh, you mean here? Oh, nice. Yeah, it's good. Okay. Now, last topic is the bigger picture, right? The global market dynamics and what's just to wrap it up everything. So, just having a broader view of the interconnected dynamics shaping, let's say, the global markets. I think the first thing is the geopolitical events. They continue to exert influence from renewed trade tensions as well as to energy supply disruptions. These factors add another layer of complexity to central banks' decision-making process. But many central banks are walking a tightrope and trying to balance the need to foster growth with the imperative to maintain the price stability. And the divergence in monetary policies across major economies on the G10 it's definitely a key theme that will continue to be going on 2025. For instance, some central banks are leaning toward easing to support the economies, and others are more into, like the Fed, the RBA, they are maintaining caution due to inflationary concerns. But I think looking ahead, several key events will be very pivotal in shaping the market sentiment. Central bank meetings is definitely one of those in December, in the month of December. It will provide a lot of clarity to us, on the policy trajectories, and as well as macroeconomic data releases are going to be very important. I think employment figures and GDP figures, growth rates, these are very, this will help the market participants to assess the state of the global economy. And yeah, I think as the year draws to a close, it's very important for investors and traders as us, any market participants to stay very informative and try to be adaptable quicker as possible, because it's a very, it changes every second. Okay. And if you understand the factors at play, then you can better anticipate the potential, and you can build more potential opportunities for the 2025 as well. So, guys, thank you so much for coming on board. We had a look at everything. We had a look at the US dollar. We had a look at the New Zealand dollar, Australia dollar, and the bigger picture as I was just talking now. So thank you so much for being here. Hope you guys have a beautiful weekend. Stay tuned. Next week is already December, and it's definitely going to be full of opportunities to us. Cheers, guys. Thank you so much. See you next week. Bye-bye.